when on the cost of goods sold and the weighted average calculations when we use tally. So many of us actually use a number of companies, and when the company data becomes very large, we split it at the end of the financial year or at any other at the month of the year or the quarter. Now the case that comes is that what happens to the cost of goods sold, what when we split the company. So when we split the company, the closing stock value of the prior company is now going to be the opening stock value of the new company, right? Now how does tally exactly handle it? So what tally does is that at the batch level, if you are doing a split, if you have kept the data at the batch level, what it will do is it will average out the values. So for example, at the end of last fiscal period, there was the last particular moments were that physical stock is 100 units, and purchase inwards was 10 units. So based on that, it will give you the value for the new time period. It will average out this all the three batch values and all the three transaction values and give you one single value, right? And give you one single value, and based on that, then it will start calculating your values for perpetual cost of goods sold. It will start calculating your inventory values for the new ensuing time period. Now our logic within turbo data is different. What we basically say is that, and what we believe is that for the owners also it will be more useful, is that the impact of the split of the company should be taken out of equation. That means that even what we what we believe is that we should get all the data for all the companies together in one single database, and then calculate the inward movement across all the companies for a given item up to that particular date. So say suppose I've got three split companies over 3 different years, then my inward movement has to be calculated across all the companies as of this fiscal date to get my correct inventory valuation. The second variation which we believe that owners might find useful is for their profitability analysis is to remove those entries which do not impact ledger. Say for example, physical stock, material in, delivery notes, and so forth, because it's these entries which actually reduce the weighted average numbers, and therefore show an inflated gross profit. What our belief is that all your inward movements should be related with is invoice entries, as well as preferable it should be related with the purchase accounts, right? So based on this, then one gets the accurate number of what am I exactly making in each transaction by ledger and item. So the problem here is, what am I making? So even if I split the company, I still need to know that what is the profit that I'm making at each voucher and each item level, right? If I'm not making a profit, then I'm not supposed to be in the business, right? I'm not there to make a sale. We are there to actually make a profit. So our case is that reduce the impact of the split of the companies, remove the impact of the split of the companies, get all the companies data together, and then get the total inward value as well as the inward quantity as of this fiscal date for each item, both batch wise and non-batch wise. Now it can happen that certain entries for an item are batch wise as well as non-batch wise. In that particular case, what we believe is that we arrive at two different numbers for the closing stock value. One is going to be a batch wise entry and one is going to be a non-batch wise entry. Then it remains on the management that whether it wants to pick up the batch wise detail or the non-batch wise detail. For example, in a particular company, there are say multiple split companies. One branch is maintaining the item batch wise, one branch is not maintaining it batch wise. So then we will arrive at two different numbers, and based on the weighted average of the same, we will arrive at your gross profit. Now the other difference which is going to be there is which is going to be quite significant is that the way tally does is that on each given fiscal date, it calculates the closing stock value Then for the next date, when the transaction happens, it picks up that closing stock value, that adds that next day's transaction, and then arrives at the net value. Our case is that we will do the complete historical value in each date using the SQL running transfer. That's the benefit of using SQL and Power BI in our particular module, as to arrive at actual accurate numbers. Right. So a number of companies have actually made use of it. Grey Orange made use of it in manufacturing. Now there are a number of other companies to arrive at accurate numbers for what they're exactly making on each transaction per item. Now this particular gross profit and the closing stock number will then go to the balance sheet and the profit and loss statement. So it will also impact your profit and loss and balance sheet. Right. And the owner will also get a complete visibility. In case you want to do it, want to find out how it is done across multiple companies, you have the details below. Contact us. We will do a POC and you can get started. We also provide one accounting analyst per customer. That means he will sit with the CEO or the CFO and help him analyze his historical gross profit and numbers. And those accounting analysts are actually going to be at the site also. Thank you very much for your time. And this was a short video. And we look forward to hearing from you.